Hello traders, and thank you for joining us for today's webinar, which will be a continuation of last week's webinar where we introduced technical indicators such as MACD and exponential moving averages. We have a lot of new people joining this week, and I have an inbox full of requests to go over materials from parts 1 and 2. So before we jump into any new information, we're going to do a recap of the last 2 weeks. But even before this recap, I do see some interesting things happening on the charts over here. Okay, so we're going to be watching the USD. We see big movement in the USD that we're going to be keeping an eye on throughout this session while we also try to go over material. So there's not quite a trade right this second, so we're going to wait on that. So let's talk about part 1, where we introduced technical analysis as a trading tool used to evaluate assets and attempt to forecast their future movement by analyzing statistics gathered from trading activity, such as price movement and volume. We mentioned that unlike fundamental analysts who attempt to evaluate an asset's true intrinsic value, technical analysts focus on charts of price movement and various analytical tools to help evaluate an asset's strength or weakness and forecast future price changes. We discussed how technical analysts believe past trading activity and price changes of an asset are better indicators of the asset's likely future price movements than the true intrinsic value of an asset. So since technical analysis is based on past trading activity, that's exactly how we're going to learn it, is going back and seeing what happened in certain situations, trying to gain a better understanding of these technical indicators. But before we get into technical indicators, first, just a little refresher on Japanese candlestick charts, which are a combination of a bar chart and a line chart. And first of all, we're using NetDania chart station here, which is what I recommend to all of you, is to sign up for a free account at NetDania, N-E-T-D-A-N-I-A. Okay, so Japanese candlesticks. You can see that there's 2 different types here. We have our blues and our oranges. And we see that each candle has 2 different parts, a solid part and a spike above and below. So let's talk first about this blue candle right here. We see the shape, this full colored part we would call the body, and since it's a blue candle, it's showing us a price increase over a specified time period. Now, when I say specified time period, this is where I specify that time period. I can make that time period 1 minute, 5 minutes, 10 minutes. I can make it an hour, 2 hours. I can make it a day, week, or month. And we'll talk later about when to use each time scale. So back to this blue candle, it's showing a price increase for this specified hour. That means that the bottom of the candle would be the opening or starting price for that period, and then the top of the candle would be the last or closing price for that period. And you see these spikes above and below, sometimes called wicks or shadows. These spikes, they show the price range within that hour. Within this hour, the price went as low as here and as high as here. But still, the price started here and ended here. So on to the orange candles. They show a price decrease over a specified time period. So that means now that the top of the body is the opening or starting price of the period, and then the bottom of the body is the closing or last price of the period. Now the wick or spikes are exactly the same for both candles. The top would show the top price in the range for that hour, and the bottom spike would show the bottom price for that range. And we know that price on these charts is separated by pips, which is a mere fraction of a penny, but also the difference between a winning and losing trade. So then we went on to talk about support and resistance, which refer to price levels on the chart that tend to act as barriers from preventing the price of an asset from getting pushed in a certain direction. We practiced drawing a few in support resistance lines. that we use to signal possible points of reversals, which would also be good entry points for our trades. So let's just look back at some examples for those of you who are just joining us for the first time today. So AUDCAD. So I have drawn a line here. And let's see just where I drew that line. Okay, so what made me draw this line here? We're pretending hypothetically that we're in the past now. It's the only way we can actually learn technical analysis in real time. If we were to try to learn technical analysis, it could take us hours or days because we're waiting for certain things to happen in the market for me to be able to show you. So what we have here is a strong downtrend that came to an abrupt halt. So this became a point of interest to me. So I drew a line here. Now, for those of you who don't know how to draw lines, you would come up here to the lines menu, select add line, come to horizontal freehand, which changes your mouse into a drawing tool, and then you can place that line wherever you want. And you can place multiple lines, and if you want to delete them, you right click and hit delete. So we've already placed this line here. Now we're pretending we're back in December. And so now that I drew that line, I'm just going to zoom back quickly, and I can see that in the past that the price did hit the similar price area after a long downtrend and then take a reversal. So this indicates to me that this support level has some strength. So now what we're doing, we're going to pretend that this is live time, and what we're going to do is wait for the price to come back down to the support line, where it's going to do one of two things. We're going to look for either a bounce or a breakthrough. A bounce meaning it's going to reverse and head back up in the other direction, or it could break right through that support level. Now we want to see it actually come to the support level for the strategy. You can see it's coming close, but still we have to wait for it to hit. And okay, is that a hit? Okay, we have a hit right here. Right now we have hit this support level, and we can see that it's bouncing off. So what we would do in this instance, since we have a downtrend and we're hoping for a reversal upwards, is we would take a call position. Now this isn't live, so we're not taking these trades right now. If opportunities today present themselves using the technical indicators that we'll be using, then I will certainly be giving trades. And that will be a little later on. Right now we are in the past. So here on this candle, we would want to take a call position, and we're going to be using what I like to call the rule of Quattro for this strategy, which would be taking our selected time scale and multiplying it by 4, meaning that if we're on the day chart, then we would be taking a call to expire in 4 days. So if we took that trade right here on April 20th, let's see what would happen. If 1, 2, 3, 4 days later, that trade would have ended all the way up there. That would be an in-the-money trade. So let's see if we get other opportunities with this support. And remember, we're waiting for it to actually come and hit the line. Okay, and we have the hit here. So that would be another opportunity to take a 4-day call. So if we did take that 4-day call, we do see 1, 2, 3, 4 that the price does begin to reverse upwards, and that would have been a great trade opportunity for us. And yet another hit right here, another 4-day call could be placed. And this one, okay, this would be a very close call. This one might have actually lost. And this is a perfect opportunity for me to tell you folks that none of the technical indicators that we will discuss today have a 100% success ratio, because a 100% success ratio does not exist. So we must anticipate to take some losses down the road. And this trade here probably would have been a loss, if not a tie. Doesn't look like it would have won. But let's push forward. Okay, here we have a breakthrough. Now, we're just starting out now, and this is how we're going to treat breakthroughs. We are not going to trade them. They indicate to us strong momentum, and that momentum could be so strong that it could actually break the support level. Now, if we go forward, we see that this wasn't the case here. And I'm not going to say we missed a trading opportunity, because this was not a trading signal, but the price did reverse upwards. Hopefully, if we go a lot further along, I can show you an opportunity where the breakthrough ends how it is supposed to. Okay, so at the time of us trading, now that this period is over, we see that it's a spike with a very short body. But at the time of trading, this would have appeared to us as a breakthrough, and I would not have traded it. And you can see that the price did go down from there, so it probably would have been a good idea not to. Okay, so then we have our breakthrough. Again, just like here, I would not take a trade here. It's indicating to me strong downward momentum. And some of you might say, hey, why not take a put position here? Well, it's not a clear-cut put signal. What it is not a signal to take a call. It's very questionable here. And let's see what happens if we go forward. We see the price break right through that support level. So that's what we're trying to see here with a breakthrough, and we're trying to avoid those breakthroughs. So this is the example of support that we discussed last week. So let's look at an example for resistance now. Pull up another asset. Okay, Euro AUD. So here we have a nice strong uptrend that comes to a brief halt, and then the two following periods hit the very same part. So I'm going to draw a line here. But one thing I'm going to do before I finish the placement of that line is I'm going to take a look back to see what has happened in the past. And if I do that, look what I see. You can see that for a very long time that price has not come anywhere close to that support. So if I keep it right at that point, I could be waiting for a very long time. And so what I like to do is bring it down just a little bit. And so now we're going to do a similar thing. We're waiting for the price of our asset to approach the resistance line. And this time we'll be looking for it to reverse downwards and take a put position. Okay, so the price is getting close here, but not touching the line. We want to see it touch, and here it touches. So here we would take a put, and since we're on the day chart, we would be taking that put for 4 days. And you can see that the price does decrease after. Let's see if we have another example. It's possible that we do not. Okay, we're coming back to the resistance line. We want to see it actually hit, and we have our hit. Here is where we could take another 4-day put, and you do see the price fall right after. And that might be it for this example. So after we discussed support and resistance in part 1, we moved on to RSI, which is the Relative Strength Index. And the RSI, once again, is a technical momentum indicator that compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an asset. So last week we compared the words overbought and oversold to overpriced and underpriced. They are not synonymous, but they will help us for this purpose. We'll think of overbought as overpriced and oversold as underpriced. So just a little review of how to apply the RSI. Let's look at a different asset. USD CHF. So we also already have our RSI here. If you want to add an RSI to a chart, you'd click here on Studies, then double-click RSI. And we can't add the same study twice. You just click OK, and you have your RSI right down here. Let me just get this out of the way to help us focus. Now, we see that the RSI is on a scale from 0 to 100, with 50 is what we would call barely priced. And we have 2 specific levels in mind that we are looking for, and those levels would be 30 and 70. So 30 would be oversold or underpriced, and 70 would be overbought or overpriced. So we can draw a line on the 30 and the 70 just to help us as a visual aid. And so let's now go back and see how the RSI would have worked with the USD CHF, for instance. Okay, so let's start here. So what we're looking for, and mind you, we're going to be sure we're watching up here, but right now we're also watching down here. And we want to see this green line touch the 30 or cross below it. And let's see if that happens, and we'll see what we're going to do when it does. Okay, so now here we see the line cross below the 30. And now what we do is wait. We wait for that price to cross back above 30. And we do see that right here in the next candle. So here is where we would take our trade. We are not live trading yet. We are still in the past doing hypothetical trades. So right on this candle, we would take a call position. The RSI is telling us that the price is about to reverse upwards. And we're on a 10-minute chart this time, so we would be using the rule of Quattro and trading for 40 minutes, and that would be 4 candles here. So let's see what happens 4 candles later. 1, 2, 3, 4, and the price is much higher than before. So let's continue, and we're watching down here. And the price drops below 30 again, right here. Now what we're doing is waiting for the price to come back above 30. And it's dropping lower, lower. And this is exactly why we wait for it to cross back above. See, we saw a little reversal here. There are some traders that would have taken that trade there and would not be successful. You really want to wait for it to cross back above the 30. Okay, now we have the cross. Here's where we would take our 40-minute call. So let's see what happens 4 candles later. 1, 2, 3, 4. The price is much higher. Let's see if we get another example. And we're watching down here, by the way. You want to see that line hit the 30. See if it happens again. Okay. It hits the 30 and it bounces right off. Right between these 2 candles is where we would have taken our trade right when we saw this bounce. So right around this time, we'd take a 40-minute call. And we do see 1, 2, 3, 4 candles later that price is well in the money. Any other opportunities? Let's find out. Okay, we have our cross over right on this candle. This is where we would take another 40-minute call. Okay, so 1, 2, 3, 4 candles later, it did come back down, but it's still above where we would have taken that trade. So that would have been successful for us. So far, so good. Okay, so that does not quite hit the 30. We want to see it actually hit. We do see the RSI still working here. When it reversed back up, the price did go up. But right now, when we're just starting out, we're going to want to wait for it to actually cross below the 30. Let's see if it happens again. Okay. Here it bounces right off 30, right at the end of this candle. So right around this is where we would have taken another 40-minute call. 1, 2, 3, 4 candles later, the price does reverse upwards. And one more time, we have it here, the crossover. We see it go dip below briefly and then come right back up. So in this candle, we could have taken another 40-minute call. And there we have it. We see, like once again, even our RSI is not 100% always correct. We see the RSI come back above 30 and then drop right back down. So that trade would have lost. But what happened is the RSI dropped below 30. So again, we can wait for the price to come back above 30 and hedge that losing position with another 40-minute call right here on this candle. 1, 2, 3, 4. That would have been another loss. So okay, so we see much instability in our RSI now. This would be a good time to back off of this particular asset and to look at another one while it is leveling out. So we also can use our RSI in the other direction. And let's look now at GBP USD. And I'm going to just draw a line here as a visual aid on my RSI on the 70. Get it as close to that 70 as I can. Okay, so here we are with our RSI 70. And now let's go back and see what happened. We'll just look at a few examples here. All right, so now we want to see the RSI cross above 70 and then drop back below the 70. All right, so we have it cross above here. We're waiting for it to cross below, and that happens in the next candle right here. Actually, sorry, it would have been right between these two candles, right in this region. And so here we're on a 2-hour chart, and using the rule of Quattro, we would take an 8-hour put. So it'll be another 4 candles. Let's see what happens. 1, 2, 3, 4, and we do see that as a success. Let's see what else we got. Waiting for that price to come above 70. All right, and here it's above 70. We want to see it cross again below the 70. And no, see, we didn't have, okay, here's our cross. This candle right here, it would have been somewhere in the middle of the candle. So, you know, around here is where we would take another 8-hour put. And we do see the price drop down after. Let's see if we get any other opportunities. We're waiting for that price. Okay, and it breaks right through that 70. We're waiting for it to come back below the 70. And that happens right in this candle. So in this candle is where we would have taken another 8-hour put. And you can see the price drop down after that. See if there's just one more example, and we'll then move on to the next topic. We'll start, this would wrap up part 1. Now we're going to review part 2. And this is because of numerous requests in my email inbox of traders who are just joining us for the first time today, and also a lot of traders who were there with us for parts 1 and 2 who basically want to review. So for popular demand, we are going to do it. And okay, so right here, that was where the price went above the 70, and now we see the RSI coming back below the 70 between these two candles, right in this region. So another 8-hour put. Okay, and this time the RSI did not work for us. And what we can see is a lot of activity on the RSI. This is great instability to me. And once again, another time to look away from this asset for a while and move on to the next thing. So that wraps up part 1. Now on to part 2, where we started to talk about moving averages. A moving average is simply a way to smooth out price action over time. Moving average means you are taking the average closing price of an asset for X number of periods. Just like any other indicator, a moving average is used to help forecast future prices. By looking at the slope of the moving average, you can better determine the potential direction of the market. But more on that later. Now we'll talk about MACD. Just one second here. Okay, so let's see if we can hold the questions for the end. We'll do a little Q&A. Right now, let's push forward. So MACD is another thing we discussed last week. MACD stands for Moving Average Convergence Divergence. This is usually one of the first indicators that new traders learn, and in many cases one of the first oscillators that traders will apply to their charts. It's also very common for those same traders to give up on MACD and stop using it, claiming that it doesn't work. It is true that MACD does not always work, but this is partially due to improper usage. MACD is a very logical indicator, and it does just what the name says. It measures the spatial relationship of two exponential moving averages. And we'll talk in more depth about exponential moving averages soon. What is an exponential moving average? Well, I guess we'll talk about it now. A simple moving average will take the average closing price for X number of periods of an asset. So, for example, if you use a 200 period SMA, simple moving average, it will calculate the most recent periods to be equal to, say, the 190 to 195 periods ago. So this can be very lagging and give us information too late. That is why exponential moving averages are very popular for technical analysts, because exponential moving averages are calculated to put more weight on the more recent periods in an attempt to make exponential moving average values much more relevant and in time with the market. So the most common default inputs for MACD are using EMAs, exponential moving averages of 12 and 26 period, along with a signal line of 9 period. So we can see here this blue line. And when we look at our charts, let's see, it's going to actually be, one moment. Let me just get something squared away here. All right, so MACD. Let me just make this bigger. Here's our MACD. So we have this green line. It's known as the MACD line. It is the faster moving line and responds more abruptly to price changes. This line represents the difference between the 12 and 26 period moving averages. Then we have this blue line. It's known as the signal line. This is a slower moving line that plots the average of the previous MACD line. This smoothens out the original line even more, which gives us a more accurate line. Then we have these red bars here. Red bars, they're also known as the histogram. The histogram simply plots the difference between the fast and the slow moving averages, the green and the blue line. All right, so let's look at an example here. So you see, looking at one of the examples from above, that as the two moving averages separate from one another, the histogram becomes bigger. And this is what we call divergence. This is the moving averages diverging away from one another. And where can we see that? See it here as well. Here the histogram gets bigger as the two lines diverge from one another. As the moving averages get closer to each other, the histogram gets smaller. And this is called convergence, because the faster moving average is converging or getting closer to the slower moving average. And this is where the name MACD comes from: moving average, convergence, divergence. So how do we use this MACD? So since there are two moving averages moving at different speeds, the faster one will obviously be quicker to react to price movement than the slower one. When a new trend occurs, the fast line will react first and eventually cross the slower line. And when this crossover occurs, the fast line starts to diverge or move away from the slower line. It often indicates that a new trend has formed. So in this picture, you see the fast blue line, which was the green line for us before, cross under the slow red line, which these lines are different color lines than our chart. So for right now, the blue line is the fast line and the red line is the slow line. Okay, so the blue line crosses underneath the red line and correctly identifies short downtrend, or right here. The blue line crosses below the red line, and we see a downtrend. So pay attention when the crossover takes place because the histogram temporarily disappears. This is because the difference between the lines at the time of the crossover is 0. As the downtrend begins and the fast line diverges away from the slow line, the histogram gets bigger, which is a good indication of a strong trend. All right, so in this image, you see the fast line crossed above the slow line, while the histogram temporarily disappeared. This would suggest that the brief downtrend would eventually reverse. And after that, Euro USD shot up. We can see right after the crossover, we see the shoot up. And that's the start of our new uptrend. So let's go to our charts quickly, see if we can find anything. All right, just to go back, we can see if we look at our MACD right here, if we were trading live right here, we see now, no, I know it's confusing. I'm going to change it for the pictures next time, but right now the blue line is the slow line and the green line is the fast line. We want the fast line to cross above the blue line here, and this would indicate to us the start of the uptrend, and that's where we could take our trade. And you see, if we did take a trade there, excuse me, that would have been successful for us. Same here is we saw the fast line cross below the blue line, indicating to us a downtrend, and we do see a downtrend start thereafter. So for MACD, I don't use the rule of Quattro. I multiply that by 2, and I actually multiply time scale by 8 instead of 4. So it's the rule of Ocho, I guess. And so here's another example right here. Fast line crosses below the slow line, and a downtrend is formed. You can continue to see that the MACD is giving us clear signals to the beginning of trends. So we did just miss this opportunity here. Let's see if we have any other opportunities to take some trades right now using the MACD. Here, we just see right now that the USD CHF has crossed above the fast line has crossed above the slow line, and we did miss the beginning of this uptrend, but the histogram is growing, indicating to us that the trend is strengthening. So we can actually take a trade here. If we're on a 15-minute chart, we're going to want to take that trade for about 2 hours. So let's see if we come over to our platform. First of all, we're going to go for USD CHF and see if there's a relevant expiry for right now. And 1630, it's a bit less than I want, but since we've already missed the beginning of the trend, we could still catch the tail end. So 1630 would be a good trade for right now. So if you enter your trade amount, I'm going to take a call position for USD CHF for 1630. Hit apply. And let's look for some other opportunities here. So that was a USD CHF call for 1630. Now I'm seeing if we have any other opportunities. And we also have a crossover here that I think we might have missed this one. Euro GBP. We see a crossover right here. This is indicating to us another bullish position for Euro GBP. So let's look for Euro GBP so we can take a call position. And we have a great expiry. Euro GBP 17. It's going to be a call. Just one moment. All right, let's see if we can get some other opportunities. Not right now. And not right now. But looks like our RSI is actually giving us some opportunities. On gold. All right, so let's draw this line real fast, and let's keep an eye on this gold. I'm going to draw a line on the 30 point of the RSI. Get as close to the 30 as I can, just as a visual aid. 1 second. Having a little, okay. So, look, we are right below the 30, and maybe by the end of our webinar, we're going to see it creep back above that 30. That would indicate to us a nice call position for gold. So let's come back to that. I want to talk also about simple moving averages, and then after that, we're going to move on to Bollinger Bands. So simple moving average is the main strategy that we've been using for trade of the day with great success. So like I mentioned earlier, moving averages display the average price for a selected period, and exponential moving averages place more weight on the most recent prices in an attempt to remove the lag associated with traditional SMAs, or simple moving averages. So I'm going to come here to a different chart, still waiting here. We might see it creep back up. We can see it bending right now. Okay, it's bending. I'm not taking a trade until I see it come back above this 30. So that's going to be a nice live trade for us that we're going to catch right on the beginning of the reversal. So we're going to keep an eye on that. But right now we're going to look away for a minute and learn about exponential moving averages. So in each of these charts, for those of you who tuned into the trade of the day, you'll see that each of these charts has 3 exponential moving averages. 200 period in the light blue, 12 period in the red, and a 26 period in the dark blue. And the first thing we will determine is exactly which way is the trend heading. This can be told by the 200 period EMA, the light blue line. So we could either look for an asset whose price is above the 200 period to indicate to us bullish sentiment, or below. Right now, this Euro USD is showing us bearish sentiment. The price is below the 200 period. And look, we actually have a trading example, because the next thing we would look for after the 200 period is for the red line, the 12 period, to cross below the blue line, which would indicate to us that the price action is about to turn back in the direction of the trend. And we do see a crossover that has just taken place. So this for us would be a nice end of day trade since we're on the 1 hour chart. So right now we could take a Euro USD put for end of day. And this is actually a pretty strong indication that we're catching right on time. So personally, I am going to increase my investment amount for this one. And we have a bearish signal. We are taking a put position. Okay, let's see if we have any other examples with our 3 EMAs. We can also obviously trade in the other direction, but right now, well, a lot of the assets are below. Okay, so here we missed it, but if we were here earlier, we saw the price was above the 200 period EMA, and right here the 12 period crossed above the 26 period. Right after that, an uptrend began. So that's exactly what we're looking for. This is not a trade now. We have missed this one. But let me look at, we have some other assets to look at. I want to see if I can give you some more live trades because of requests from the emails. So let's see. Euro AUD, maybe. Looks like the red line's turning back up, so that's not going to be an opportunity for us. I want to just come back to the gold real fast and see where we're at. Oh, sorry, I actually clicked the wrong one. Oh, one moment. Okay, still bending. We're waiting for that price to get above the 30. And you can see it really wants to, and it's almost there. And hopefully by the end of the webinar, we'll be able to take this trade. I'm going to see right now if we have any more exponential moving average opportunities. And almost immediately I can see that right now the opportunities are weak for this particular strategy. So perfect opportunity to move on to some new material. For those of you who are waiting, I apologize, but we want to keep our whole class together, and I think it will be most beneficial to include everyone at once. So just give me a minute here. So Bollinger Bands. So determining the momentum of a trend can be challenging, especially during volatile market conditions. So especially during volatile market conditions after a big news event. Bollinger Bands can be particularly useful in helping to understand how volatility is changing, and furthermore, when momentum is overextended in one direction or the other. Bollinger Bands are used for trading pullbacks in momentum or even trend reversals by determining again whether that asset is overbought or oversold, just like the RSI. So named after its inventor, Bollinger Bands were invented by John Bollinger in the early 1980s. It's a technical indicator which calculates the distance of price from a simple moving average that closely tracks the price action in the trading asset. Bollinger Bands are set both above and below the moving average to a distance that depends on the volatility based on earlier changes in price. Mathematically speaking, the distance of each Bollinger Band from the SMA is typically set at 2 standard deviations of an average of earlier price volatility. And we do have a figure here to look at. Okay. So according to the math here, it shows us that low volatility conditions will be indicated by narrower bands, while highly volatile conditions will result in wider bands. You see the bands are wider here, and here they are closer together. This means that when price of an asset either touches or crosses a Bollinger Band, it must be an extreme directional move that, based on the higher or lower band, could indicate conditions in which the asset is deemed overbought or oversold. So the simple moving average is typically set to 21 periods when used alongside Bollinger Bands, which are set to 2 standard deviations. So most traders like to wait for volatility to level off, indicated by Bollinger Bands that are closely hugging the SMA, to help spot breakouts in action. And these breakouts usually result after an instrument has been trending in a narrow range for an extended period of time. I think we actually have some examples of that here. Let's see. Oh, actually, we've had extreme volatility lately, so okay, so I don't have an example of that, but just 1 second before I forget, I want to check on that gold. This gold is going to be a good trade for us. And I hope you guys see now why we're waiting, because had we taken that trade, the price has gone down since we first saw this. We want the RSI now is about to creep above the 30 line. Let's wait just a little longer. We see it's creeping above. I'm just going to wait to make sure it's not a false alarm. Okay, so we'll come back to that. Okay, so popular Bollinger Band patterns that are worth trading. Let's come back to our Word document for a second. All right. So one of the most popular patterns that traders watch for with Bollinger Bands is the identification of M tops and W bottoms in price action. Here's an example of a W bottom. Bollinger Bands can be useful in identifying potential entry points for trades and even breakout opportunities. So a bullish bottom pattern is formed by two consecutive bottoms in price action, which typically resemble the letter W. However, so, if we're taking the trade here, then we don't see the W. We would see an upside down N. And the key is to take a bullish position near the Bollinger Band, the lower Bollinger Band, which would have been right here. And it's important to note that neither the top nor bottom band are impenetrable, and price can, in some occasions, continue to drop. Okay, so this would be a W bottom. Now let's take a look at an M top. So a bearish top pattern is formed by two consecutive tops in price, which form an M. However, obviously, if we're watching this live and want to take the trade here, then we didn't see this yet, and it would appear to us to be an N. Okay. So if price action of the second top pushes higher than the first top, it is a signal to forego the opportunity and on to the next, but in this case it has not. So let's look to our charts. And okay, so look what we see here. Before we get on to Bollinger Bands, I'd like to take this opportunity to trade some gold. And our RSI is indicating to us a call position now. If we're on our 15-minute chart, we're using the rule of Quattro. That would give us a 1-hour trade for gold. And I am trading this. This is a highly confirmed trade for me. 17 GMT. And yes, this is a highly confirmed trade. I'm going to take a call position on the gold. I'm glad we got that one in before the end of the webinar. Now back to Bollinger Bands. I'm sorry to be jumping around like this. We've had many traders ask for live trades during the webinar. I'm trying to give everybody everything. So now we're back to our Bollinger Bands, and we're looking for either M tops or W bottoms. So I can show you some examples here, and maybe not in this chart. Well, actually, each chart, when you change time scale, it's going to tell a different story. And okay, so I'm looking for a good example to show you guys. And we've had a lot of volatility in the last couple of days, but this could be viewed as an M top, a bullish pattern. Basically, not right now, but we do see that the first time it hit the Bollinger Band was here, and then the second time it hit the Bollinger Band was in the same area of price. So this would be a good chance to catch a reversal if we were there. And we would use the rule of ocho for this one. We would multiply our 30 minutes times 8, making it a 4-hour trade. And let me just back up for a sec, because I realized I did not show you how to add Bollinger Bands. Basically, every technical indicator we're talking about can be found in the studies. So we would double-click the Bollinger Band, and that, if you click that, it's going to add this blue line above and this red band below. It does not add the moving average that I have. Now, this moving average is a nice middle point for me to mark, and I added that by coming to moving average and changing period to 21. It's also important to change the color, because if I left it as blue, I would have two blue lines, and that would be very confusing for me, so I've made it green. And I'm really hoping to show you guys some more opportunities. So according to our lesson, we see a W bottom here, but the price went lower than here. So our studies tell us to forego this opportunity. And let's see if we can find anything else, maybe on the 1-hour chart. Okay, so I would like to keep watching this for later. If you are on a 1-hour chart, you can watch to see if the price does come down to this point here. It probably would be a good indication for a call position. But let's move on to another asset, because I not seeing the best opportunities. I want to see right now. Okay, well, here we have some extreme action in the USD JPY. We saw that the price did break through the upper band here, and now is beginning to come down. Now, we can also combine indications. So right now, the Bollinger Band is telling us to take a put. And we're waiting right here, and we're going to see the RSI also cross below 70. So let's watch for a minute. I have a feeling that it's about to take place. You can see this line bending as I speak, and it's bending downwards. Okay, more downwards, and it actually is. I'm going to draw that line to help you guys as a visual aid, and hopefully we'll be able to take a USD JPY trade in just a minute. Okay, so let's just keep this here while I try to find some Bollinger Band opportunities. I mean, we do see, we also might have just missed this one, but once it hugged the band momentarily, it did reverse back upwards. And this is actually an M-top pattern. This would have been a great one for earlier, but we did unfortunately miss it. We saw the first occurrence, the AUD/USD hit and broke the top band, came back down, and went up again. At this point, we would have seen an N shape, the letter N, and once it hit that band again, would have been a good opportunity for us to take that put position. And if we took that put position, it would be for around 80 minutes. We could do an hour. We're not really going to see 80-minute expiry, so an hour trade would have ended us somewhere down here. So it's safe to say that that trade would have been a winner. Okay, so all right, we're almost below 70 here, but I want to see if we have any Bollinger opportunities. Now, I'm trying to give you guys strong signals today, so I'm not seeing a strong Bollinger signal right now. It's great that we've found some other trades using our other strategies, but I don't know that we'll be able to use Bollinger Bands today. It's just not a strong enough indication right now. Well, good thing we took that call on the gold. The Bollinger Bands are telling us the same thing. So we'll see how that turns out later tonight. Okay, so maybe we have something here. Okay, so you guys might want to keep an eye on the Euro GBP for later. And if it comes up to this level of the Bollinger Band, it's likely that it could take a reversal after that. So later on, Euro GBP might be a good put. Let me just take a quick look at the GBP USD to see if there are any opportunities. But one thing we can't focus on is how the Bollinger Bands, they change with volatility. The very thin ones show low volatility, and when we have high volatility, we see very wide bands. So okay. So if we keep watching this, pretty soon it might take a reversal, but right now we can see there's still much stronger downward momentum. So I don't think we'll see a Bollinger opportunity today. I'm going to wait around with you just for a couple more minutes. Well, looks like our RSI is turning away from the 70. We might not be able to take this USD JPY trade, but for you guys at home, netdanya.com, sign up for an account and open up the chart station. The first asset you should open, you would search for your instruments down here, type in USD JPY, click on the interbank option. Okay, so you would open this chart. The first thing I want you guys to do when you get home is add in your RSI. Come over here to Studies and RSI. So you added your RSI. Now the next thing you would do is draw a line on the 70 right here. Okay. And be watching the 10-minute chart. Okay, well, you actually won't have to do that because we have our crossover. Let's come over to our platforms right now. A strong indication of a USD JPY put position. And we're using our 10-minute chart, so we're going to trade just under an hour. So 1645, and it's telling us to take a put position. USD JPY put for 1645 is a very strong signal right now. And that's about all the time we have for today's webinar. We're gonna see, we actually went over time. I'm gonna see if I can get in a couple questions for Q&A. I was not watching the clock at all. We were actually out of time, but let's see if anyone can get in some quick questions. But for those of you not sticking around for the Q&A, I'd like to thank each and every one of you for joining us for today's webinar, and I hope to see you all back next week when we start to talk about stochastic oscillators. So each and every one of you are going to receive a registration link in your email to join the webinar in the coming days. And so for those of you not sticking around for the Q&A, have a great weekend, and thank you for joining me today. We had a huge crowd, and I'm very, very pleased to see you all. And I'm going to see if I can answer some questions right now. But I apologize that I don't know if I'm going to get to them because we are out of time. A lot of these questions seem to be in Russian. I do apologize. We do offer Russian webinars, however, I'm not the one doing them. I would like to see questions that pertain to the topics we discussed. And Alex, I can't really understand your question about the fourth candle, if you can reword it. And what's the trade for 5 p.m. today? Kim, you're going to have to specify. We're all in different time zones here. If you could specify in GMT, I'm not sure exactly what your question is. And those of you saying thank you, you are more than welcome. Thank you for joining the webinar. And Penny, if you could reword your question about RSI, do we wait until it bans? I'm not sure what you mean by the word bans. Okay, so I'm going to stick up or down. Still, Penny, to trade RSI, do we wait until it bans up or down? We can use RSI in both directions, both with the 30 and both with the 70. If it is coming down to the 30, we wait for it to cross below the 30 and come back above the 30. And if we're using with the 70, we want to see it come above the 70 and then cross back below the 70. So unfortunately, that is all the time we have for today, guys. Let me just bring up my email address. And I apologize. I know a lot of you have emailed me from last week's webinar, and I haven't even got a chance to respond yet. That's how full my inbox was, and that's how many people are participating in this webinar, which is excellent news. We're more than pleased to have all of you, and I apologize if I haven't responded yet, and I'm certainly going to do the best I can to get to those emails. But if you do have further questions, you can send them to this email address. And beyond that, you can request a one-on-one session with myself. All you have to do is contact your account manager and make such a request. And someone is asking for archives. I'm not sure what you mean. Please send me an email, and I'll be happy to answer your question on archives. Okay, so everyone, have a great rest of your day and a great weekend, and I hope to see you all next week. Bye now.